Hello, investors. Have interest rates got your portfolio down? Well, it's certainly not a surprise. Inflation's at 40-year highs. The Federal Reserve has to reduce its accommodation and even raise its interest rates in order to combat inflation, but try to thread the needle so that it doesn't kill our kind of fragile economy. And market multiples, even though we're at all-time highs and have come off a little bit, are still getting cheaper. And history has shown us that typically multiples don't stop on the decline and stop at fair value. They usually go through their fair value on the way to cheap. My name is Stuart Cruz. I'm founder of Cruz Asset Management. We're a boutique, quantitative, virtual family office that helps you invest with the odds in your favor by using math and statistics. Now, I'm going to show you a couple ways that you can still make money in this challenging market. But first, we're going to talk a little bit about the bad news. Up on the chart, up on the screen, I've got a chart of the federal funds rate. And what that says over the last 10 years, it's peaked at about 2.25. And I'm going to put up here the 2-year treasury rate. And you can see right here, for the most part, the 2-year treasury rate is above the federal funds rate. But here it went underneath that. That's called an inversion of the yield curve. And that's the inversion of that federal funds rate and the 2-year treasury. And why does that matter? Well, if I put on this chart U.S. recessions, you can notice that right after we had an inversion, there was a recession. I'm going to take this off for a second and again demonstrate that the 2-year treasury note has risen substantially, but the Fed funds rate is still at 0, which means probably in order to combat this inflation, the federal funds rate is going to have to rise. And we're talking about 25 to 50 basis points, but you can see the spread throughout the last 10 years has been considerably larger. So they're going to have to raise this up in order to kind of meet that high level of return. So why does that matter? Well, if we raise that short-term rate, and right now I have the 2-year rate on here and the 10-year treasury rate, this is another indicator of potential recessions. As you see, the 2 and the 10-year tends to trade over the 2-year. But when it's gotten close, again, we've seen a recession. So here is another recession, and now it looks like we're getting close. So if the federal fund rate goes up and causes the 2-year rate to go across the 10-year, that is an inversion of the yield curve. Now, I'm going to break this all down by adding the actual spread. So here is, instead of the 2 and 10, here is actually a chart of the spread. So what that means is whenever this goes below 0, that means the yield curve is inverted. That means the 2-year treasury rate is paying more than the 10-year rate. So right now we're only 23 basis points apart. So if the federal funds rate goes up 25 to 50 basis points, which drives the 2-year up, that could cause an inversion and potentially a recession. So here we touched at 0 and we had a recession. So let's see how true this is. If we go back through history, I look back through 40 years of history. The federal funds rate went below 0, we're in a recession. The federal funds rate went below 0, we had a recession. Federal funds rate went below 0, recession. Below 0, recession. Below 0, recession. This happens over and over again. It's not a guarantee, but it's a pretty darn good indicator that the economy is in trouble when the yield curve inverts. So what are you going to do? And we haven't inverted yet, but we're getting awfully close. So what are we going to do? Well, back in the 2000s, when we saw 2 of these recessions, the S&P 500 had 0% return over that decade. Now, what helped you was diversification. And I don't mean diversification meaning that in your asset allocation you also owned Apple stock and Microsoft stock. That is not diversification. Diversification means you owned international, you owned commodities, you owned Bitcoin, you owned other things besides domestic large cap growth stocks. A diversified portfolio during the 2000s actually returned about 7%, and that was with moderate risk. Other things that you can do are tactical management. And what is tactical management? Well, I'm going to put up a chart of the S&P 500 right now. And if I look over this is a 10-year chart. Over the past 10 years, the S&P has pretty much gone straight up. But over the past 2 years, it took a whole different trajectory straight up. And now it looks like it's breaking down. whenever we've seen this different angle take off, and you see a breakdown of that angle, normally we see a regression back to the mean. So it wouldn't be unusual for it to follow that previous trend and to come all the way back to a range kind of in here. But if we're still saying that we're going to have higher interest rates, higher inflation, that we might be in a recession, is it more likely that the S&P is just going to go straight up, or is it going to look more like some international markets that we have? So here's a chart of the international market that goes up and then went down, and then up, and it went down, and up, and it's on its way down. Here requires tactical allocation. So do we have signals that say buy, 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 and we get in, and sell, sell, sell where we get out? Buy where we get in and ride this wave out. Sell, and then buy back in and ride this wave out, and then sell on the downturn. Your portfolio is going to require tactical allocation, and we can show you how to do that. And finally, we can show you how to use structured notes to give you a payout that's structured according to what we believe is going to happen. So if we think we're going to have lackluster returns, we can leverage that upside and give up very high end, put a cap on that ceiling of 15 or 20%, because we'd be happy to get that return in a market environment where the multiples are high and it's likely that we'll continue to see headwinds. So I'm Stuart Cruz. I'd love to show you how we can use multiple methods in order to help you get returns in this challenged market. Now, I've seen some really egregious and terrible portfolios over my time, and I don't want that to happen to you. So go ahead and click on the link below to start your free Riskalyze test, and we can see if your risk is in alignment with your portfolio, which is also in alignment with your goals. Go ahead and click on the link below, and let's get started.